Welcome to CEO Money. I'm Michael Yorba. Thanks for joining with us. I have Patrick Bourbon, founder of Bourbon Financial Management, on the show with us today. Patrick, welcome to the show.
Hi, Michael. Great to be here.
All right, Patrick, I'm glad you're here. Now, there are 16 scary facts you should know. Walk us through those.
Okay, so last week was Halloween, and we sent a newsletter to our clients and friends about those 16 scary facts, and I'm going to go through a few of them with you today. If you want to see them all, they are on our website, patrickbourbon.com, in the newsletter section. So the first one is about the average performance of an investor. So there was a research that showed that 20 years performance of the average investor was 2.3%, which means if you had invested $100,000 at the beginning, after 20 years you will have had $157,000. So it's a 57% cumulative performance. But now if you had invested into a 60% stocks, 40% bonds portfolio, very simple, you will have had 6.9% return, which means 279% in a cumulative way, which means your $100,000 would have become $379,000. It's more than $200,000 more. So that's one issue about the performance of the average investor.
Got it.
Another slide was about the probability of living until 95 years old. How long will be your retirement? So today, if you are a retired couple, 65 years old, healthy, the probability that one of you live until 95 years old, which is 30 years in retirement, this probability is 43%. It's much higher than what people believe. It's a long retirement. Another slide was about the cost of healthcare in the US. Today, we have estimates between $250,000 to $300,000. That will be how much the average couple will be spending during retirement on healthcare, not reimbursed. Mm-hmm. Another scary fact is inflation. We didn't talk much about inflation in the last 10 years. It starts to come back now, but if you look at long term, since 1978, you look at education costs, they went up more than 1,000%. If you look at medical care costs, they went up 597%. So you have to pay attention to inflation. Another scary fact is how much people saved, because they don't realize how much they're going to need to retire. So let's assume you spend $55,000 today. At retirement, with inflation, maybe it's equivalent to $100,000 you will be spending then in 20 years. How much do you need to retire if you want to spend $100,000 per year? In this case, if you assume 30 years in retirement, it looks like you may need, based on this research, more than $2 million. Many people don't realize how long is retirement and how much they need to save. So what can you do about that? So let's look at other facts which kind of give you some strategies here. So Michael, would you like to save half less money and have 47% more at retirement?
Of course.
Okay, so let's see how will it be possible. So in this slide, I showed that if you start to save today $10,000 per year for 10 years, so you save $100,000, you invest it and you wait. You wait for another 20 years. At the end, you may have above $700,000. But now, if you didn't know that and you start to save 10 years from today, and you start to save $10,000 per year, like the first case, $10,000 per year, but you save for 20 years this time, not 10 years. So you save $200,000. Guess what? You never catch up with the first person. You only reach close to $500,000. So, Michael, if you want to save half less and have 47% more at retirement, you just have to start sooner.
Mm-hmm. Makes sense.
Same idea, but it's so important to make people save sooner if it's possible. The next slide is the same idea. How much should I save if I want to have $1 million at retirement? So this slide shows that if you start at 20 years old, you need only $310 per month to save, starting age 20. But if you start at 50 years old, you need more than $3,000. It's more than 10 times more per month. It's going to be very difficult to reach $1 million if you start at 50 years old. Another solution is to try to improve the portfolio returns of your portfolio, which means this study, what happened in this study is they show that if you increase just by 1% the return of your portfolio per year during your lifetime, and 1% is easy to lose or gain, meaning maybe you just lose 1% that you give to your financial advisor if he's charging you a percentage of your asset, which this is not what we recommend. But 1% more per year is equivalent to a lifetime, the life of your portfolio will be 12 more years. So if you want a retirement to last 12 more years with the same portfolio, just try to improve the performance of your portfolio by 1% per year. People don't realize how big could be this impact. Another idea, next slide, is about diversification. So let's say, Michael, would you prefer to invest in one fund at 6% per year for 30 years, or do you prefer to invest in 5 funds? On average, those 5 funds have the same 6% return, but one of them may return 0, one may return 12% per year. What do you think?
Well, I think that the diversification is just a standard rule. Everybody should adhere to it. Don't put all your eggs in one basket.
Exactly, but people don't understand the power of this diversification. And in this slide, you can see that if you were to put $100,000 at 6%, you wait 30 years, you have $574,000. You're happy. You multiply your money by more than 5 times. But what we are saying is diversify. Buy a fund, 2, 3, 4, 5. Maybe one of them will be bad, and you will make 0 over 30 years. Very bad. But maybe one of them will do 8, maybe one of them will do 12, and if on average those 5 funds do 6%, guess what? The total amount in your portfolio will now be above $1 million, so it's 74% more. It's much more. So another idea is avoid market timing if you want to have a more comfortable retirement. Let's say you invested $10,000 in the market, in the S&P 500 in 1997, and you wait 20 years until the end of 2016. You do nothing. Very simple. You buy an index fund, $10,000. After 20 years today, even though we had a big crisis, 2001, 2002, we had another one, 2008, you lost half of your money. But guess what? Over 20 years, your $10,000 became $43,000. Multiply more by 4 times. You got around 7.7% return per year. But now, because you listen to the news, because you're afraid, you make emotional decisions, you listen to bad advice, sometimes you may be out of the market. Today is election day in the US, so you may be afraid about what's going to happen, you may be out of the market. Who knows? You are always scared about something. But if you miss just 10 days during those 20 years, the 10 best days, I don't know if tomorrow is going to be the best day or not, but if you miss 10 days out of maybe 5,000 trading days, you never know when are those 10 days, your retirement income could be half less. The $10,000 you invested became only $21,000 instead of $43,000. That's a big difference. So the main message for this slide was, don't try to do market timing.
Yeah, many people are not good at it, so you have to be exceptional to really hit that one right.
Very, very few people can do it. The statistics are against you. So if you want to find more facts like this, again, patrickbourbon.com, you check out the newsletter section.
Patrick, thanks for being a guest on today's show. I enjoyed the slides and the wisdom that you bring to the table.
Thanks for having me, Michael.
You're welcome. You've been watching CEO Money with Michael Yorba. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.